Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, it's been a little while since we last had you on, and quite frankly, I would love to just stick to some of the precious metals charts, the ones that you follow most closely, starting off with, let's say, the gold chart, simply because, look, the tail end of last month was looking pretty bad for gold. We had a couple week breakdown there. Gold on the spot market got the whole way down to about 1823, and then it very quickly rebounded. It was about 2 Fridays ago that gold started to turn, and it seems like some of these geopolitical fears have given an extra little boost to gold here, and even the stocks turned. However, we are still at this point where we need a little bit more upward momentum to break these lower highs and lower lows that gold has been putting in really since that peak in April, May of this year. Jordan, just how important has this recent turnaround over the last, let's just say, about a week and a half now for the precious metals?
Yeah, Corey, I think it's really interesting because gold last month had a clear technical breakdown below 1900. And also, if we're looking at just pulling up a daily chart, on the daily chart as well, like you did have several days where it fell below 1850, where there was a confluence of support. And if you're looking at gold against the stock market, gold against foreign currencies, right before the market bottomed, you did have breakdowns in those charts, fledgling breakdowns, you could say. So there's a saying, from false moves come fast moves. And judging how gold has moved following its bottom, it kind of fits the notion of a false breakdown, because after gold put in its bottom, intraday, I think it got down to 1823 just after the beginning of October. And then the day after that, it gapped up, which is interesting. And then it kept rising after that point. So you had this bullish reversal at the bottom, a bullish intraday reversal. And then the day after, you had a gap up. And after that, gold kept running. So all that happened before you had the big upside explosion last Friday. And, it pulled back a little bit. But even today, we're talking, I see 1965. Intraday, it's traded as high as, looks like, 1976 almost. So, I mean, this is getting, in 2000 on the weekly chart is very significant resistance. I mean, this is, if you're a gold bear, I think gold is getting, it's getting to the point where it's, I'm not saying it's going to break out the next month or two, but if you're just looking at the numbers, now it's about $100 away plus a little bit, from a new all-time high. And it's just, if you're a gold bear, it's just kind of getting dangerously close to that point. So I think with how gold made its bottom and how there's been really good follow through, I think that's a really good sign. And I think that gold's obviously coming up to significant resistance here in the 1980 to 2000 zone. But this is, if you're a gold bull, this is what you want to see, because turn it back a month ago, gold had a technical breakdown. It fell below 1850, and all the support there was down to 1820. Then you have to start thinking, well, this is going to go to the 1700s, and then you get this big rebound. And by the way, I think it's more than just what's going on in the Middle East, because if you think about it, you could go back to Russia and the start of that war, and early 2022, the Fed was starting to hike at that point. Turns out the economy was not going to go into a recession at that point. I mean, I know it was a technical recession statistically, but compare that to now, where you look at the yield curve, that's starting to steepen. It's getting closer and closer to zero to indicate a recession. The Fed knows it really has to stop hiking, but if you're looking at the market, bond yields are still moving higher. So there's this is a different situation than the last time we had the start of a war. So I think there's more to this move than just a war premium. I think that's kind of underlying the strength here. So it doesn't mean it's going to break out in the next month or two, but we're seeing very good signs, and gold is getting really close to that major resistance, pretty close to the point where the market would have to just say, okay, it's broken out. This is the start of a new secular bull.
Yeah, Jordan, I'm really glad you brought up that point that there's more going on than just the war premium, because even last time in 2022, when we saw that, you're completely spot on. The Fed was actually speeding up their tapering to get ready to start hiking, and all of those market jitters were already there, and gold was already moving before the Ukraine war even started. It's the same kind of thing we saw this time, where the gold reversal actually happened on non-farms payroll day, and that was that sharp reversal 2 Fridays ago. We've also had higher than expected CPI. There's still a lot of people wondering how all this plays in, including the geopolitics, to what the Fed is going to do. A lot of people have decided, or at least postured, that the Fed is not going to be able to hike as aggressively as they could have been, considering the geopolitical backdrop and the inflation backdrop. And so there's a lot of other forces going on than just one thing. It's convenient for people to paint things with a one size fits all brush, but obviously geopolitics are playing a factor. Looking back at the charts again, though, Jordan, on the short term, there was that gap that was created, not just in gold, but we also saw that in the mining stocks. And it's nice to see gold back above the 50-day moving average and the 200-day moving average. It had dipped down below there on that big breakdown a couple of weeks ago. Now we're back above it. Is there any risk that this thing needs to backfill those gaps, though? A lot of pundits and technicians online are talking about that they could be breakaway gaps and not get filled, but a lot of other people are saying, no, things are going to retrace back down and fill those gaps. What's your thought on that discussion?
Yeah, gaps are really annoying because they're definitely confusing, and there's never, well, with respect to gold, the problem with gaps is you have overnight trading, and so gold's all over the place, and so it produces lots of gaps. The miners are gapping all the time. I think with respect to gold, you can see there's support at 1860. Below that there's a gap. I definitely would disagree with the notion that gold has to fill that gap before it keeps moving higher. At this point, I think it would be a worse sign if gold came down to fill that gap. And I mean, you can go back to 2008 to 2011, or even 2018, or I should say the COVID move in 2020. Like if you look at those points in the miners, like there were open gaps at the very beginning or around the beginning of those moves. So I wouldn't make the gaps more significant than they really are at this point. I mean, given, again, gold's at 1860, it went above 1960 today. I would just completely disagree with that it has to fill the gap, before it can move that much higher. So I'm not that worried about gaps at this point. I mean, what it comes down to for me is what it usually does, or, at these various points in recent years, gold against the stock market. And I'm looking today, and it seems like that's made a good move. I'm looking just using the ETFs. It's up over 2% today. It looks like it is at the highest level since June. So what is that, about a 4-month high? So, that to me is really significant. Like if we continue to get gold outperforming the stock market, even just if you tell me gold's going to outperform the stock market for the next month or two, then I would say this is going to rally back to 2050. You would have to lean towards that in the near term. So I'm more concerned with that than gaps on the charts.
So, Jordan, I guess the big question is then for investors in gold is this bounce that we saw after that very oversold condition at the beginning of October. What are we going to have to see level-wise to confirm that this is more than just an oversold bounce in a bigger, I guess, downtrend? Or what does actually show that maybe this was just an oversold bounce? What are some of the key levels on the upside and downside?
Yeah, gold, looking at the weekly chart, there's quite a bit of resistance at 2,000. So if you get a weekly close above 2,000, that's really significant. If we're looking at gold against the foreign currency basket, it looks like the all-time high was made in the spring of this year. So if we see that making a new, gold against foreign currencies, if that makes a new all-time high, that would be a great signal. And also, gold against the stock market, that needs to trend higher and, basically confirm the nominal strength that you would be seeing in gold.
One more question on gold before we shift to the mining stocks, Jordan. From a longer term chart perspective, when you look at the monthly charts, they really hadn't gotten too oversold, and they were just starting to flirt in October with getting kind of below neutral and starting to go negative for the first time. There's some technicians' thesis that you really need to see them get oversold first on the monthly on some of the indicators before there's really going to be enough oomph to come in and really lift gold to new highs that are going to sustain those new highs. Are you in that camp where we still maybe need to see more weakness on the longer term charts first, or are we out of the woods at this point with this recent rally?
Definitely not in that camp. I mean, you can do time span analysis, which is something I don't talk about a lot, but it is interesting where you're looking at, okay, well, the market's been above this moving average, or it's been above this level for way too long. And normal, I mean, when this type of analysis, when you're looking at 10, 20, 30-year charts. And so you're just looking at, okay, well, it's gotten to the point where it probably needs to, or the odds favor it coming back to this moving average or a certain level. But I mean, with respect to gold's been consolidating we're more than 3 years into this consolidation, and it's holding up really well. And I don't see any reason why it would have to come back down to a certain level. Doesn't make any sense to me. I mean, I pulled up a monthly chart and looking at the RSI, and we know that in a bull trend, or we know that 70 tends to be overbought, 30 oversold, but in a strong trend, you usually go above 70, usually get to 80, 85, and then in a bull market, in a strong trend, on the bottom, you usually see 40 or 50. And so I'm looking at gold and RSI. The 2020 peak, it looks like the RSI got up pretty close to 90. Now, gold's you could call this a cyclical bear. It's been consolidating for 3 years. At the 2022 low, it looks like the RSI got to 40. So that's evidence of a strong trend, meaning the high was close to 90. Now the low in 22 is at 40. And if you look at the last month, the RSI came down to 50. So that's more evidence of a strong trend. I mean, we're taking a bird's eye view. So looking at that, I just don't see the logic or the reasoning that, gold needs to come back to a certain level, or it needs to spend X more time correcting. That to me is not the bearish case for gold. And by the way, when you're looking at momentum indicators, and they need to come back to a certain level, those are all derivatives of price. So I'm not a huge fan of using momentum indicators. I think if you're going to make a bear case for gold, the bear case would be, we're still in a secular bull for the stock market. We're still in a secular bull for the US dollar. So that, and if those continue, that's going to prevent a certain amount of capital from moving into gold. So that to me would be the argument and the reasoning behind thinking that this range bound market in gold, this consolidation, would have to continue for another 6 months or another year or two, versus, well, on the chart it did, this indicator needs to come to this certain level. I just don't buy that. I take a more holistic view, and it has to do with capital flows and secular trends.
So, Jordan, let's move over to the precious metals stocks then, because something like GDX, look, if you go back long enough, you can make the argument that we're seeing higher lows, 2016, 2020, 2022, and then maybe this recent one as a low as well. But you go back a bit shorter time in 2020, then 2022, and 2023, we're seeing lower highs. Very much so, GDX is trading right in the middle of this range from 2020 to about 2022, the highs being in 2020, lows being in 2022. What are you seeing in the stocks here? We're hearing a lot about how these stocks are struggling, but what are the charts telling you about the potential of where GDX goes?
At this point, I don't want to make it too simple, but it's all dependent on gold. I mean, to be honest, the miners are going to be almost dead money until we get gold breaking above 2,100. Now, the rebound from 1823 gold up to wherever it goes on this move, I mean, almost hit 1970 today, or hit 1975. Certainly the miners have had a good move. I mean, one thing I'll be watching in the days and weeks ahead is the advanced decline line, to see if we get a real breadth thrust. Now, we did have one of those in the spring, which turned out to be a false signal. I just pulled up a chart. I mean, a 15-day breadth thrust still have a little ways to go, but that's something that we need to see in the short term if this move in gold continues, broadening participation, widespread buying. That would show up in the advanced decline line. And, when you get that breadth thrust signal, and we need more and more strength to get that signal. But if you get that kind of a signal, that signals that the move is sustainable and you're probably going to see more buying. So that to me is what I'm looking at. If you want to look at GDX, the 30 level, if you're just looking at a daily line chart going back 7, 8, 10 years, that's a significant level. So if GDX, or maybe it pulls back a little bit at 30, but then it explodes up past 30, gets to 32, 33, that could be a real bullish signal that tells you this move is probably going to have staying power. But they're just, if we're stepping back and looking at the fundamentals, and I know you guys look at economic studies and you interview lots of companies. It's been really difficult for these companies if you think about how much costs have gone up in the last 3 years. The costs have gone up a lot. The economics on these projects have gotten a lot worse compared to 3 years ago, even good projects. And, there's just not, you don't have that much value in a lot of these studies when costs have gone up so much. And, you're using 1850 gold or 1800 gold or 1900. It's just not moving the needle. So you're not moving the needle in this sector until gold takes out 2100. Now, if gold takes out 2000, you get a weekly close above 2000, that could bring in a lot more buying in the sector, certainly. But, ultimately, if you finally take out 2100, then you're going to get a lot more money coming into the miners, versus the metals. And it's just, it's not rocket science here. We know that costs have gone up a lot. The top line, gold and silver prices in the last 3 years have not made new highs. But if you get a breakout in gold and you're looking at 22, 23, 2400, that's going to make a huge difference for all these mining projects. So long diatribe aside, it really comes down to gold breaking 2100 for these stocks.
Yeah, Jordan, it would be positive for all the companies if gold broke 2100. But just to follow up on that, because I think there's some nuance around that discussion about the point you just made about rising costs. Yes, there's been rising costs due to inflation, undoubtedly. But there's also been rising metal prices. The average annual price of gold in 2022 was the highest it's ever been on record. In Q2 of this year, it was the highest quarterly average price of gold ever on record. And when I went back and looked just last week and did some research on what the margins actually were at the peak of the last cycle, in 2010, they're around $440. And in 2011, at the very peak mania, it was about $620 was the average margin. Well, if you look at where gold is now above 1900 and where the average costs are, 1250 to 1350, they've absolutely gone up from where they were around 980 to 1100 a couple of years ago in 2020. So costs have gone up, but the margins are still 550 to 650 the last 2 years. They're right where they were at the peak of the last cycle. But the companies are valued a fraction of where they were at the last cycle. So even though costs have gone up, margins aren't that different than they were a decade ago. The highest margin ever was in 2020 at $800. And the stocks failed to make a new high. They didn't even eclipse their highs in 2016 when gold was a lot lower and margins were a lot lower. So is there something else going on just besides cost and margins?
Dilution, equity dilution. That's another problem for a lot of these juniors. Think about in the last 3 years, you're in this cyclical bear market in gold, even worse for the mining companies. So you have 3 years where your stock is trending down, you're not making money, and you have to keep raising. So you have, even if we take your word at what you're saying about margins, they have come down significantly in the last 3 years, however you want to look at it. You have that, and then you have, let's just say a company had 200 million shares out 3 years ago. Even if they try and do a good job, at this point, they have 250 or 260 million shares. That's another 30% dilution. So just the nature of the business for these companies that are not cash flow, and even go and look at a lot of the companies that are producing and cash flowing. I mean, they've had a lot of dilution too. It's not just limited to the explorers and developers that are not generating any cash flow. So that's, you have margin compression. And in addition to that, it's a business where you have to print shares to survive and raise capital. That's why the average stock is down 70% or 60% or whatever it is.
Yeah, fair enough, Jordan. But you know what? Like, prices are good for these metals companies. Costs have also come up. And look, we can dissect these numbers all we want. Fact of the matter is, the market just is not valuing these companies anywhere close than where they were a little over a decade ago. Jordan, let's get you back on again soon just so we can follow up with how these markets are moving. It does sound like gold. Even the gold stocks are at some pretty critical points right here for us to follow up on. So, hey, thank you very much for giving us some insights on what you're seeing. We'll chat again soon. If you want to follow up with Jordan, go visit the Daily Gold website. Thanks for your time, Jordan.